Albert Einstein supposedly called it the eighth wonder of the world, saying, "Those who understand it earn it, and those who don't pay it." It's quiet, it's invisible, and it doesn't show up on your statement screaming for attention. But given enough time, it'll out-earn your job, outpace your hustle, and outlive you. Last week, we talked to you about policy loans versus bank loans. This week, we're pulling back the curtain on compounding interest. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWell Finance.
All right, that Albert Einstein quote, I don't think he actually said it. I think there's a lot of skepticism. There's no investigation that's turned up an actual quote that he said that. But I have seen where he's talked about compounding and the power of compounding, not necessarily compounding interest and the way that people love to quote it in the finance space. But compounding numbers is the eighth wonder of the world.
Yeah, I think a lot of people really attribute quotes to Albert Einstein in order to give it that credibility. But whoever said this is really, they're right. Compounding interest is one of those things that continues to help just grow wealth beyond anything that you will do on your own. In the end, the goal should be that your money makes money for you. And that's really the power of compounding interest.
All right, so let's hop into compounding. What the power of compounding? Obviously, we're going to be talking about compounding interest because everything we deal with in this podcast is about high cash value. So, of course, we're talking about interest. One of the things that we like to discuss is a lot of times we'll have comparisons made between the growth in a life insurance policy and the growth in the stock market. And people love to point out that the stock market has averaged 8% or 10% or 12% every year. The problem with this comparison is that the stock market goes down sometimes. And it kind of hurts that compounding growth, not just in the actual sense of the compounding growth, but also when people tend to talk about averages.
Yeah, I think that's generally it's factored into some of those returns where people will call out these averages, and it might even be including inflation. But whatever the case, if you have something drop 50%, which there have been times in the stock market where the market has dropped 50%, in order to get back up to where you were, you need 100% gain. And that's something that it's hard to sink in order to really understand that. Another thing that you can consider is when you have that 50% drop and 10% gain, and you average those things out, that averages out to 25%. And so that is a really big thing to consider when you're looking at some of this stuff.
Yeah, that 25% average, the reality to you is there was no growth. And so we can't just look at what those averages are because there are negatives that can happen there. However, in life insurance, when we look at internal rates of return, and when we talk about averages, there's no negative years in this cash value growth. So we are getting a true compounding of the rates that we're looking at.
Yeah, and I think that's really where you're not taking those big steps back. It's a really powerful thing. It doesn't mean that it's going to outperform the stock market. I think in the big grand scheme of things, it will tend to be over a long enough time period. The stock market should outperform, but having the life insurance in the toolkit gives you a lot of different things that can help with your overall wealth growth journey.
Yeah, 4 and 5% internal rates of return may not sound like much, but because you don't get the negatives, you don't have the pullbacks that you have to recover from. It's just that steady growth that's going to continue to grow and compound. That's why this ends up being very powerful and leads to way more growth than most people will expect. We're so used to seeing the ups and the downs, and the problem with being in the actual market is you're also riding that roller coaster. So do a lot of people see 10 and 12 or 8% averages from being a stock market investor? I would argue a lot of people don't because of the emotional toll that it takes to be in the ups and downs of the market. A lot of people can't handle that.
Yeah, and I think that's a really big thing to consider is when you're in the markets and all in on the markets, it can be nerve-wracking. One of the things that I kick myself for is when I had a large NVIDIA position, the pre-split, very nice position that could have netted me high six figures, maybe seven figures if I had held that. But I just didn't have the nerves when I thought crypto was this is pre ChatGPT blowing up and all that stuff. So I thought crypto was going to go down. All that stuff led me to selling that position. And I have multiple positions that are like that where I exited way too early. And so that's a thing that it hits everybody. Even though I'm kind of tapped in and I understand a lot of these different things, you, you never really can get over. This time it's different. Nvidia might go to zero was in my head. And I don't know. It gets like that, especially when you're talking about tying up tens of thousands of dollars in a single position.
Now, we can't do a podcast about uninterrupted compounding growth without talking about the penny that doubles every day for 30 days. It's the classic example where what would you rather have, $1 million today or a penny that doubles every day for the next 30 days? And a person who is not knowledgeable in compound interest might think, oh, I'll definitely take $1 million. But somebody who does know about compounding interest, they know that that penny, if it doubles every day for 30 days, is going to turn into over $5 million. And there's no way that you would choose that $1 million up front if you actually know how compounding works.
Yeah, and I think that's the big thing is when you can put away a good chunk of money to really let it grow on its own. And the beauty of life insurance is when you put that money there, it doesn't mean you can't do other things with it without interrupting that compounding as well. So when you consider that, there's not very many assets that really give you that ability to not have a huge opportunity loss, but lock in those compound interest gains over time.
So the power of this is the uninterrupted compounding. Well, what happens if we do interrupt it a bit? In the case of, let's throw in a tax in there. A penny a day, if you had a 20% tax during your growth period, so 20% each day of those 30 days, instead of $5.37 million at the end of 30 days, you're left with $12,200. That is a drastic reduction in what's available.
Yeah, and I think that's one of the things that you'll hear a lot in the space that is anti-life insurance or anti-even financial advisor sometimes. This low-cost index people who are all about the low expense index fund, which there's nothing wrong with those. I have funds in low-cost index funds, but there are some people who say that's the only thing that 99% of people should ever do, and they'll talk about that. And you can do those calculations on, James just called out a 20% tax, but if you have a management fee in that 0.5%, 1%, 2% range over the long term, that can really make a difference. And so really, I think that's the thing. Any kind of drag can be something that impacts your long-term wealth. But when it comes to whole life, and we're talking about this 4 to maybe 5.5 internal rate of return over the life of that policy, that doesn't sound like a giant number, but we kind of know that going in. And it's one of those things that has such a solid history of that kind of performance. And then what you can do with that is the power of that.
It also speaks to why we design the policies the way that we design them. We want to minimize the expenses in every policy that we sell so that more money is available for growth and compounding. Because even adding a little bit of an expense can make a big difference 30, 40, 50 years down the road due to that compounding.
Yeah, I think that's really that the optimizing design is really that same thing. That is when you minimize those expenses, it's the same as getting rid of some kind of assets under management fee for your stock market funds. It's a powerful thing that puts money back in your pocket, and even more so than like self-managing a brokerage account or a retirement account. With life insurance, it can be much more set it and forget it because you don't have those steps back that you got to be worrying about. Even with low-cost index funds, when you're hearing about some conflict overseas or this or that thing, that whatever the macroeconomics that could create a 30% haircut, it's natural to want to start moving money into safer vehicles, and people will end up doing it if they're self-managing.
I don't like to compare the cost of managing funds that happens in the market with life insurance as if it's not going to have some type of a cost like that. It's not an overt cost, but internally, even the best designed whole life policies, we're going to see 0.7 to 1.3 internal expenses over the life of a policy. That's on the best designs. So it is going to be comparable from an expense standpoint, but we do get to do away with the downsides. We do get to do away with the negative years, which really does make a difference.
Yeah, and I think that's one thing that I'll make the analogy sometimes, where if you're paying that, 0.5% to 1.5, 2% to assets under management, I assure you, I've never heard of any kind of fiduciary or financial advisor that is going to give you a guarantee no step back. But the contractual ability to do that in these life insurance products, it's like I'm buying that to some extent, and I'm getting a death benefit on top of that. That's the way that I think about it. You don't have to think about it like that, but I think I like to look at it like that. It is buying that downside protection.
I do like to think about it that way as well. We know that for that 0.7 to 1.3%, if something happens to us in the early years, the return on capital is going to blow any investment, any traditional investment out of the water. We could see 1,000% return or a 500% return if we happen to die in the early years of these policies, because that death benefit is just going to be so big compared to the amount of money we've put into it. Long term, now that 1% that's been coming out as an expense inside of our policy, it still ends up being worthwhile because it was liquid the whole time. We've had that growth. We've had that compounding growth where it's never gone backwards, and we're still going to experience 6, 7, maybe 8% internal rate of return on that death benefit should we happen to pass away. But if we want to utilize the cash value, we still have a significant internal rate of return on the cash value portion that's available for us to use while we're still alive.
Yeah, and I think that's a really powerful tool, and we talk about it in almost every episode where we might mention it, is when you have access to that liquidity, what can you do? What opportunities can you execute on? And how can you do things differently? Because you have this opportunity to borrow against a policy. It still is compounding over there. Yeah, you're paying an interest rate that is comparable to really wherever else you might access capital, but you could go buy a piece of real estate, even invest in the stock market if you wanted to, whatever the opportunities you see that arise. And in those 2008 financial crisis types of circumstances, you still have access to that capital, and you can capitalize on all other assets going down and buy that dip or that crash.
Yeah, one of the best things about these cash value policies is that we can just collateralize them. We never stop that growth compounding curve. It's going to continue to grow on that underlying value of the policy, even if we're accessing cash against it to go make other investments. Now, you can do this similar thing with some other assets. You borrow against your house. It doesn't interrupt the value that your house would otherwise get to. But you may not be able to get that loan in any given year. Depends on your financial situation, your job stability. If you want to get a loan from the stock market against your portfolio, you can do that too. It might come with a margin call at the most inopportune time when the market is crashing, and you've now got to come up with money to meet this margin call, but you also need money somewhere else. And yeah, it just doesn't work out well when we have to deal with margin calls in the stock market. So life insurance gives us the space to be able to go do the other investments that we need without concerns about the margin call and without interrupting that compounding growth.
And another big thing with that, let's say you are doing this with your brokerage, some kind of securities-based line of credit, and that margin call happens because crashing scenario, it can happen. You could have already had a gain on those funds, and you might be borrowing against what are gains. And so if it ends up being that you are forced to sell those positions, on top of trying to do everything else, you might have to be covering a gigantic tax bill. So that's why I think, even though I could tap, I have some pretty secure investments in some brokerage accounts, I could tap that, and maybe I will at some point, but that's only because I know that if I'm in a scenario that I won't go to high utilization of that line of credit, and if I need to, I can tap my life insurance to cover that. And really, that's the power of this is knowing that a lot of these tools are in my back pocket when I need them.
All right, uninterrupted compounding. Make sure you're earning it and not paying it. Next week, we're going to talk about the 3 keys to high cash value life insurance. Don't miss it. It's going to be a good one. Appreciate you joining us today. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. We'll see you next week.
Thanks for tuning in.